Hey everyone, welcome back to Corporate Decoder. Today, N.I.N.E Energy Service, Incorporated just filed their quarterly report for March 2026, and I am seeing a huge shift after their bankruptcy. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company just emerged from bankruptcy and the way they show their money now is completely different, making it tough to compare to the past. Alright, so N.I.N.E Energy Service Incorporated has just filed its quarterly report for the period ending the 31st of March 2026. This filing is a big deal because it is their first one after coming out of bankruptcy proceedings. They call this a successor period, meaning the company after its financial rebirth. Everything before the 5th of March 2026 is labelled Predecessor the company before its restructuring. It is like looking at two different companies, so we have to be careful when comparing numbers. Let's dive into the numbers. On the balance sheet, which is like a snapshot of what the company owns and owes, we see their assets. Total assets for the successor company at the end of March 2026 were about $326 million. That is down from about $339 million for the predecessor company at the end of December 25. Their liabilities. What they owe also changed dramatically. Total liabilities for the successor are around $192 million, a massive drop from over $454 million for the predecessor. This huge decrease in liabilities is a direct result of their bankruptcy exit. Stockholders' equity usually shows how much the owner's stake is worth. After emerging from bankruptcy, the successor company has a positive stockholders' equity of about $134 million. That is a huge turnaround from the predecessor company, which had a deficit of over $114 million at the end of 2025. This positive equity is a strong sign of their financial recovery. Now let's look at how they performed financially during this period. For the successor period from the 6th of March to the 31st of March 2026, they reported revenues of about $41.6 million, but they ended up with a net loss of over $1.2 million during this short period. Contrast this with the predecessor period from the 1st of January to the 5th of March 2026. Revenues were much higher at nearly $88.4 million, and impressively they reported a net income of over $107 million. This big profit in the predecessor period is largely due to the bankruptcy reorganization itself. Specifically, a gain on liabilities subject to compromise. In the most recent successor period, revenues were $41.6 million. Their service revenues brought in $33.1 million, and their product revenues were $8.5 million. This is a pretty good revenue number for just a few weeks of operation. Back in the predecessor period, from the start of the year up to their bankruptcy exit, revenues were $88.4 million of that. $71.1 million came from services and $17.3 million from products. Looking back to the same time last year, the 31st of March 2025, revenues were significantly higher at $150.5 million. This shows a substantial drop in overall revenue compared to 2025, likely impacted by the economic climate and their bankruptcy situation. For the successor period, the cost of getting that revenue was high at $35.6 million. This includes materials, employee costs, and other operating expenses. For the predecessor period, the cost of revenues was $80.5 million. This period also included significant inventory write-downs. General and administrative expenses, the overhead costs were $4.6 million for the successor period. For the predecessor period, these costs were much higher at $13 million. This difference is probably due to restructuring related professional fees in the predecessor period. This is where the bankruptcy really shows up. For the predecessor period, they had a massive figure of $124 million in reorganization items. Net, this is the financial impact of emerging from bankruptcy, including gains from debt restructuring and related professional fees. The successor period had no such items because the restructuring was completed. Looking at operations, the successor period had an operating loss of $856,000. The predecessor period also had a much larger operating loss of $11 million. This loss in the predecessor period was before the significant gain from the reorganization itself. Interest expense for the successor period was relatively low at about $542,000, mainly from their new exit ABL facility. In the predecessor period, interest expense was much higher at $5.3 million, largely from their old 2028 notes. So the bottom line for the successor period, N.I.N.E Energy Service reported a net loss of $1.2 million. But for the predecessor period, they reported a net income of nearly $108 million. This large profit is almost entirely due to the fresh start accounting and the gains from reorganizing their debt. Let's look at the equity section. After bankruptcy and applying fresh start accounting, which essentially resets their books to fair market value, they now have 13.9 million shares outstanding. This is a massive change. Before, they had over 43 million shares. The pre-bankruptcy equity was a deficit of $114 million, but now it is a positive $134 million. This is the most dramatic indicator of their financial rebirth. In this short successor period, they generated $41.6 million in revenue. Cementing services brought in $17.6 million. Tools were $8.5 million. Coiled tubing was $8.1 million, and wireline services were $7.5 million. Now, cash flow. This tells us how much cash is actually moving in and out of the business. For the successor period, they used $2.4 million in cash from operations. This is their active business activity. Investing activities used another $3.4 million, mostly for buying new equipment. Financing activities used less than $1 million. Overall, their cash position decreased by almost $6.6 million during this short successor period. In the predecessor period, cash flow from operations was a negative $10 million, even though they had a huge net income. A lot of that was non-cash gain from the bankruptcy. Investing activities used $2 million, and financing activities actually brought in over $20 million. Mainly from the DIP ABL facility and the Exit ABL facility, which are loans related to the bankruptcy. In total, their cash position increased by about $8.6 million in this predecessor period. Their debt situation is totally different. Before bankruptcy, they had over $369 million in debt. Now, after emerging, their total debt is around $94 million under the new Exit ABL facility. This is a massive reduction. The old 2028 notes are gone, replaced by new equity given to the former note holders. The company's risk factors section highlights a few key points. They've just come out of bankruptcy, and that can affect their relationships with suppliers, customers, and their ability to get financing. They also caution that their future financial results might not be comparable to past projections because of all the changes. They are very clear about this point. The numbers they used to get their bankruptcy plan approved are not meant to be followed closely now. They were based on specific assumptions about the market and their business that may have changed. Investors should not rely on those old projections. They also provide an adjusted EBITDA, which is a way to look at their operating performance without certain charges like interest, taxes, depreciation, and amortization, plus other one-time items related to the bankruptcy and restructuring. For the successor period, their adjusted EBITDA was about $2.1 million. For the predecessor period, it was significantly lower at $870,000, even though they had a huge reported profit. This highlights how much the bankruptcy itself distorted their reported net income. Looking at their ability to pay bills, they expect their cash on hand, cash flow from operations, and borrowings under their new Exit ABL facility to be enough for the next 12 months. They are planning capital expenditures of $20 to $30 million for 2026, which is a pretty normal amount for a company their size. Their total liquidity at the 31st of March 2026, including cash and available credit lines, was about $46.9 million. Now for my take, N.I.N.E Energy Service has made a dramatic financial turnaround by successfully emerging from bankruptcy. Their debt has been slashed, and they've reset their balance sheet with fresh start accounting. The successor company reported positive equity, which is a massive improvement. However, the revenue figures are still significantly lower than a year ago, and the short successor operating period showed a modest loss. The massive net income in the predecessor period was heavily influenced by the bankruptcy process, not necessarily by core business operations. But the big question is whether they can grow revenues and achieve consistent profitability in this competitive energy sector. The fact that they generate nearly $1.3 million in adjusted EBITDA during a tough quarter, even with restructuring costs, shows some operational resilience. It will be crucial to see if their new structure allows them to operate more efficiently and compete effectively. Given the post-bankruptcy reset and the improved financial structure, it is a cautious optimism for now. The tools I use to analyze these filings are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.